Well, hello, everybody. This is Louis LeBash, and today we're going to talk about the best retirement plan of the 21st century. The best retirement plan of the 21st century basically has to do with, in the 1990s, the insurance companies came out with a product called Index Universal Life. This product was designed to compete directly with the high-flying stock market. But unlike the risk of investing in the markets, these products had built-in safety features that removed the risk inherent with investing directly in the stock market. Since the year 2000, the high-flying markets have crashed and burned a number of times, and overall have not done very well since the high-flying days of the 1990s. At the same time, these new Index Universal Life products, with their built-in safety feature of zero downside risk, along with the ability to participate in only the growth of the markets they are tied to, have done very well and look to continue doing so going forward. A great deal of the money that was lost in the markets in the last 10 years was invested in mutual funds through the use of qualified retirement plans, most notably 401k plans. Now, I put together a 4-page document about the history of 401k plans that include an interactive financial calculator to make it easy for you to evaluate how we can use these Index Universal Life products to build what I call the best retirement plan of the 21st century. Now, the program looks, the document looks something like this. Basically, it's 4 pages long, and I'm not going to read the document to you, but basically it gives you the history of the 401k plans and some of the goods and the bad things about them. But on the 3rd page of the document, there is this little calculator that is built into it. And I'm just going to jump over to that document right now and show it to you. And if you look at this, this is page 3 of the actual document itself. And if we right mouse click on this little calculator, it says full screen multimedia. And I'm just going to click that. And what that does is that takes that little calculator and puts it up full screen so you can take a look at this. And the whole idea behind this is that, first of all, we're going to help you compare this, what I call the best retirement plan of the 21st century, the last great tax saver versus a qualified retirement plan. And the way this works is that I'm going to click right here. And essentially, it gives you an idea of what this is. You may wonder what it is, but it's really an Index Universal Life contract. And the idea behind this is that this is a next-generation life insurance contract. It's not to be confused with your father's traditional cash value life or universal life insurance contracts. It uses recent life expectancy tables with competitive low-cost insurance rates, provides an immediate income tax-free death benefit, also provides access to the savings element of the policy without any government penalties before age 59.5, and the money can also be available income tax-free. All or part of the savings element can be tied to the growth and only the growth of major stock market indexes. If you choose to participate in the growth of the market, you will do so without any downside risk. All of the internal growth of the policy's cash values are tax deferred, and it allows you to access the cash values through tax-free loans using the policy's preferred loans or wash loans feature so that you can have access to the money in the policy on an income tax-free basis at little or no cost. Also has an overloan protection rider or feature that makes the policy last forever. So it can't lapse, and therefore it would cause a taxable event. It's the best and safest platform currently available to build a tax-free retirement income for you. And so what we're going to do here is that in this program, I've gone and run programs for a 35, a 40, a 45, a 50, and a 55-year-old male using an A-plus rated company and also running these at standard insurance rates. There are better rates available, and if you're healthy or healthier than standard, you would get a better rate, and these numbers would come out better. What we're going to do is we're going to show how these people can take $10,000 a year and put it into a policy versus putting that same $10,000 after tax into their 401k plan and see what would be a better way to go. So we're going to close this down for right now. And the first thing we're going to talk about the current plan. So generally speaking, we're going to go and click on this button up here. And what we have is $10,000 going in. We're going to male age 35, all right? And his current tax rate is 30%. And he's going to retire at age 67. And if you have this document yourself, you can change the ages, and you'll see that we can go up a year or down, up 5 years to 40 or 45 or backwards. Just depends on where you want to go. As we touch these things, you'll see they go up, and the numbers change dynamically. So we're just going to go back down to the 35-year-old. And the way you would use this is that whatever age that's closest to you, this would give you some approximate numbers. And again, it's $10,000 is going into the policy. Current tax rate is 30%. We can change that as well. And we're going to put $10,000 in all the way to retirement, age 67. And we have them having a 35% tax rate coming out. And the reason we have this is that we're pretty convinced that taxes are going to go up. And also we're thinking that this 35-year-old person who is currently in a 30% tax bracket is going to make a lot more money in the future, and their tax rate is going to go up in spite of it. So we're going to just project a 5% increase. Also, we projected in the policy that we're going to get a 6.7% rate of return over the next 32 years, or all the way to age 100. And we're going to project that same rate of return in their 401k plan. And the way the policy works is that it says that if you do this $10,000 a year for 32 years, you could actually take $108,000 income tax free out of the policy, starting at age 68 all the way to age 100. Now the 401k plan, because this $10,000 is after-tax money, you actually can put, if you're in a 30% tax bracket, you can put $14,000 a year into your 401k plan. And then the problem is that when you go to take the money out, in order to get $108,000 out of your 401k, because all the money that you take out of it is taxable, you're going to have to withdraw $166,000 a year to net 108. And at the end of the day, you'll be able to take $1,400,000 out of your plan, out of your 401k plan, until you run out of money. And basically it shows here that it maxes out at $1.5 million in the 32nd year, and then you start taking the money out and it actually runs out of money in the 45th year. So this 35-year-old at age 80 effectively spent all their money by taking the money out in these amounts. So what we're going to do is show you that what this means is that what we're doing here is we're actually, by taking the $10,000 after tax and putting in the life insurance policy versus putting in the 401k plan, people say, well, I'll put the money in the 401k plan and get a tax deduction, when you do. And the taxes that you would save over the next 32 years would be $137,000. That's what you get to defer. But the problem is that when you go to take the money out, because you have to pay taxes on all the money when you take it out, you have to pay $759,000 in taxes taking it out, which is a $621,000 difference. Now, again, this is all deferred and it's growing, and then you have to pay taxes, all these taxes when taking all the money out. The real problem with this is that once you take the money out to pay the taxes, that money is no longer available to earn anything. And that's the big problem with these 401k plans. Not only do you have to take out a lot more money to keep it going, but by taking it out and giving it to the government, you no longer have use of the money. Now this is the last great tax saver illustration. And basically this shows putting $10,000 a year into the insurance policy for 32 years, and then being able to take $108,000 out all the way to age 100. So basically this just shows us small numbers going in, big numbers coming out, and that looks pretty good. And then we're going to show you the cash flow comparison. This is the money that you're putting into the 401k plan, and it's $14,000 versus the $10,000 that you've put into the policy, because you have to make $14,000 to get the $10,000. So if you put the $14,000 into the 401k, you'll notice it goes along here. And then when you go to take it out, the problem is that to get the $108,000 that you can get out of the policy from the 401k, you have to take out $166,000. Well, this extra, $56,000 or $58,000 that you have to take out every year, and once you take it out, it's gone. You can't use it. You don't have to take it out of the policy. It continues to work, and so subsequently, all this money lasts this much longer. And that's the big key to this whole thing. So just to go forward here, I'm going to just go ahead and click on the benefit increases just to show you what's in it for you. So this over here basically shows the 401k plan on your current plan. So if you were to put the $14,000 in the plan, if you passed away, if you had an accident and this 35-year-old passed away, there would only be $10,000 available, because even though you put $14,000 in there, the taxes have to be paid, even if you die on your 401k. So if something happened, you get in the first year, you would get $10,000 for your survivors, versus the insurance policy, because it's required to be an insurance policy, has almost a $300,000 benefit. That's 2,900% more money if you died the first year. Now, when you get out to age 100, as we mentioned earlier, that the 401k plan runs out of money at age 80, So there's no money available at age 100, but this insurance policy actually grows to be $1 million worth of insurance. So there's a $1 million benefit at age 100, a lesser number earlier on, but there's always an insurance benefit. And then if we talk about the cash flow, the policy itself will pay you out $3.5 million versus $1.4 million that you get out of the 401k plan, which actually works out to be a 253% increase. You get 253% of the money that you would receive from your 401k plan. And if you add in the death benefit, it ends up being a 330% increase overall. So we earlier talked about getting 25 to 40%, and that's what the brochure talks about. But the real numbers can turn out to be dramatically greater. Now what I'm going to do is I'm just going to go ahead and move this down, and I'm going to show you what happens if we had a 4-year-old. And you'll see the 40-year-old, his overall cash flow is a 233% increase using the same idea and the same way we handle the money. And if we go to the real difference is that the 40-year-old, he buys less insurance because he's older. We buy the minimum amount of insurance that's required in order to make this work. And then we go to the 45-year-old who buys even less insurance, but he still has 200% more and 259 total overall. And if we go to the 50-year-old, again, the longer you wait to do this, and the older the less time you have to do this, the numbers are going to get smaller and smaller. It's just the power of compound interest. So the 50-year-old only has a 177% increase over the number, so it gets about almost twice as much money back. Over here, totally gets over twice as much money back. And if we go to the 55-year-old, again, it's not quite as good, but then again, it's still better. And on day one, he's got $146,000 of death benefit versus $10,000 in cash. At age 100, he's got $133,000 of death benefit versus 0. And the cash flow, again, is 31% more, but still 31%. It's a big number. And the overall death benefit and cash value is 70% more. So, and that's just the way it works. And basically, the whole idea behind this is that you can pick the age that you are closest to these numbers and figure out what's approximately what it would be for you. Also, remember these are standard rates. It could be better if your health is better. And the best way to find out about this is to have your advisor actually put together a program just for you. So right now, I'm going to right mouse click on this, and I'm going to end this full screen multimedia. And we're back at this page again. I'm just going to tab back to the presentation. And essentially what happens is we go to the last page, and the last page basically tells how this works. Now, remember we said we can increase your retirement income by 25 to 40% or more, and it's definitely on the more side. And the way it works is that we take away the taxes, and the way we do that is that we use these tax laws that were passed by Congress called DEFRA, TEFRA, and TAMRA, and we buy the minimum amount of life insurance required for the premium that you put in there. That allows you to take all the income out of the policy on a tax-free basis, on an income tax-free basis. And again, remember, this is a new generation life insurance product, not to be confused with traditional whole life insurance. This product is much more flexible, has much better rates of return, and again, because of the 0 taxation, provides you right out of the box, depending on whatever your tax bracket is, at least that much. And then because you don't have to give the money to the government, it's still in there working for you, and you get that again. Also, it has this unique feature built in it called annual reset. And the way that works is that the money is tied to the indexes that you pick that you want to have your money grow with. But if the indexes should happen to have a negative year or a down year, the money does not go down. You just retain the value you had at the beginning of the year. So you can't lose any money in these products. And the best way to find out more about this is that you just need to call the advisor that sent you this video. So this is Louis LeBash. Just want to thank you for your time. And remember, contact your advisor, have them build you a personalized version of The Last Great Tax Saver, and get the best retirement program of the 21st century. Again, thank you for watching.